My name is Michael Grandi. I'm a certified public accountant and I'm a professor at Providence College. We're recording this lecture today. This is a PowerPoint presentation from chapter 19 of the Kimmel Queso textbook, 7th edition. And the title is Cost, Volume, Profit Analysis, Additional Issues. So I'm going to share my screen with you so we can start the PowerPoint presentation. And we'll start it from the beginning. And we will duplicate slides on both screens so we can see both of them. Okay, so we're not going to cover all 74 slides. We're going to make it through slide 53. We're not going to cover operating leverage, and we're not going to cover variable cost and absorption costing. So this is a cost, volume, profit analysis. And as I mentioned, we're going to talk about only the first 3 learning objectives here. We're going to talk about applying basic cost, volume, profit concepts. We're going to talk about what sales mix is and how to calculate break-even point, and then determine sales mix when a company has limited resources. So learning objective 1, cost, volume, profit analysis. The study of the effects of changes in costs and volume on a company's profit, costs, and volume. Remember what volume is. Volume is activity. Volume is essentially the number of units we sell. And it's important for profit planning. Again, we're trying to find ways to improve profitability, finding out what the effects are on changes in costs, whether they be variable costs or fixed costs, what are the effects of changes in sales price, what are the effects of changes in volume, ultimately on what? On profit. So how do all these changes possibly affect the profitability of our company? Because again, we can change the sales price, we can change the variable cost per unit, we can change the fixed cost, and we change the number of units we sell. The question is, what is the impact on net income? What is the impact on break-even point? So some basic concepts. Management often wants the information reported in a special format income statement. This is the cost, volume, profit income statement. It's used for internal purposes. It's not used for external reporting purposes. And when we talk about external reporting purposes, we're talking about preparing financial statements for shareholders and regulatory bodies. The reports on the contribution margin are in total amount and also on a per unit basis. Costs are classified as either fixed or variable. So here's an example. This is Vargo Electronics, and it's for the month ended June 30th, 2020. They are currently selling 1,600 cell phones, and their selling price per unit is $500 per unit. Their variable cost per unit is $300 per unit. Consequently, their contribution margin per unit is $200. Their fixed costs are $200,000, and they have $120,000 of net income when they sell 1,600 units. This is an expanded version of the contribution format income statement. Sales and net income are the same. And what did they do? They just broke out the variable expenses for you. They're telling you variable expenses include cost of goods sold, selling expenses, and administrative expenses. Those are the variable portion of those items. Now, let's keep in mind, all 3 of these items, cost of goods sold, selling expenses, and administrative expenses, are mixed cost. That's mixed with an M. They're mixed because they have both a fixed component and a variable component. And you can see they put the variable components up towards the top and the fixed cost down towards the bottom. So break-even point units. Vargo Electronics CVP income statement shows that total contribution margin is $320,000 and the company's contribution margin per unit is $200. Contribution margin can also be expressed as a contribution margin ratio, which is 40%, which is the contribution margin divided by sales. And we can calculate the break-even point in units. The formula for break-even point in units is fixed cost divided by the contribution margin per unit, in this case, 1,000. So when the company sells 1,000 units, they break even, which means net income equals exactly 0, which also means that their sales equal their total costs. We can also calculate break-even point in sales dollars, and that formula, which you've seen before, is fixed cost divided by the contribution margin ratio, which in this case is 40%. Break-even point in sales dollars is $500,000. Once a company achieves break-even sales, a sales goal can be set that will result in a target net income. Assume Vargo's target net income is $250,000. Compute required sales in units to achieve a target net income. And this is very similar to the break-even point in units. Remember, the formula was fixed cost divided by contribution margin, which gives you break-even point. The target, when we calculate break-even point, the target profit is assumed to be 0. So all we need to do is modify this formula to add our desired net income, our desired target profit of $250,000. And you can see they need to sell 2,250 units to break even. Now, to have a target profit, pardon me, of $250,000. Can also calculate target profit in sales dollars by taking the target profit plus the fixed cost divided by the contribution margin ratio, and you see $1,125,000 in sales dollars to achieve a target profit of $250,000. We can calculate the margin of safety. Remember what the margin of safety is in dollars. It's the actual sales minus the break-even point in sales. In this case, it's $300,000. We can calculate the margin of safety percentage by taking the margin of safety divided by the actual sales. In this case, 37.5%. So our illustration here is our original cell phone sales and cost data for Vargo Electronics is shown. The selling price per unit, $500. The unit variable cost, $300. The total fixed cost, $200,000. And we've calculated break-even point in sales of $500,000 or 1,000 units. So here's some variations. A competitor is offering a 10% discount on the selling price of its camcorders. What effect will a 10% discount on selling price have on break-even point? So what if Vargo decides to match the selling price by discounting their sales price by 10%? Sales price per unit is $500. 10% discount would be $50. So we're trying to calculate break-even point in units. And that formula, again, is fixed cost divided by the contribution margin per unit. But here, the contribution margin per unit changes. It was $200 per unit. It's now $150 a unit because we dropped the sales price by $50. They now need to sell 1,333 units to break even, or 333 more units than previously. Break-even point in sales. So management invests, here's a scenario number 2. Management invests in new equipment that will lower the amount of direct labor required to make cell phones. So that's a variable cost, right? Direct labor. They estimate that total fixed costs will increase. So variable costs are going to go down, fixed costs are going to go up. The variable cost per unit will decrease by 30%. Fixed costs go up by 30%, variable costs go down by 30%. What effect will the new equipment have on the sales volume required to break even? So there's going to, again, the formula, fixed cost divided by the contribution margin per unit. Fixed costs are now $260,000, right? They were $200,000. A 30% increase is $60,000. The new fixed costs are $260,000. The contribution margin per unit also drops because the variable costs, the direct labor specifically, drops by 30%. The variable cost per unit was $300. 30% is $90. 300 minus 90 is $210. The new contribution margin is 500 minus 210, or 290. Break-even point in sales is 897 units. So the break-even point units drops from 1,000 units to 897 units. Case number 3. Again, looking for ways to improve profitability and what the impact is on break-even point. Vargo's principal supplier of raw materials has just announced a price increase. Raw materials are going to go up. Raw materials, direct materials, are a variable cost, so variable costs are going to go up. The higher cost is expected to increase the variable cost of cell phones by $25. Remember, the variable cost was $300 per unit. We're going to add $25 per unit. Management plans a cost-cutting program that will save $17,500 in fixed costs per month. Vargo is currently realizing monthly net income of $80,000 on sales of 1,400 units. What increase in units sold will be needed to maintain the same level of net income? So this is not so much a break-even point calculation. This is a target profit calculation. So the new variable cost is $325. As I mentioned earlier, it was $300. They added $25. The new fixed cost is going to the $200,000 minus the cost savings of $17,500. The new fixed cost is $182,500. Contribution margin per unit is now $175 rather than $200. And in order to calculate the number of units they need to sell to maintain an $80,000 profit, it's the fixed costs of $182,500 plus the target profit of $80,000 divided by the contribution margin per unit of $175. They need to sell 1,500 units in order to have a net income of $80,000. Here's a question for you. This company calculates its contribution margin to be less than 0. The contribution margin is less than 0. So what does that mean? It means essentially that their selling price is less than their variable cost. Item D. This company reports the following for the month of June. Sales of $300,000, sales price per unit $60. They're currently selling 5,000 units. Their fixed costs are $100,000. Net income is $20,000. To increase net income, management is considering reducing the sales price by 10% with no changes to unit variable cost or fixed cost. Management is confident that this change will increase unit sales by 25%. So they're going to do what? They're going to decrease the selling price by 10%, and they think they're going to sell more units. Using the contribution margin technique, compute the break-even point in units and dollars and margin of safety in dollars, assuming no changes to the sales price or cost. So where are they right now? Okay, before this considered change, where are they right now? Break-even point, 4,167 units, which again is the fixed cost divided by the contribution margin per unit. So look back, the contribution margin per unit is $24. The fixed cost is $100,000. That's the number of units they need to sell. This is what the break-even point in sales dollars has to be. So again, it's the $250,000. It's the $100,000 in fixed cost divided by the contribution margin ratio of 40%. And the margin of safety, again, actual sales minus break-even point sales, $50,000. Using the contribution margin technique, compute the break-even point in units in dollars and margin of safety in dollars, assuming the changes to sales price and volume are described. So the break-even point in units, again, it's the fixed cost divided by the contribution margin per unit. Remember, they cut the sales price by 10%. The contribution margin per unit was $24. They cut the sales price by 10%, which is $6. The new contribution margin per unit is $18. The fixed cost stayed the same. They need to sell 5,556 units to break even. Sales dollars, remember, it's the fixed cost of $100,000 divided by the contribution margin ratio. Contribution margin ratio is not $54. It should be a percentage, right? It should be a percentage. And that percentage, I can't believe the publisher made that mistake. So remember, the new contribution margin per unit is $18. Divided by a selling price of $54, the contribution margin ratio is 33%, right? It's the contribution margin, which is the new one at $18, divided by the new selling price, which is $54. So 18 divided by $54 is 33%. So $100,000 divided by 33% is $300,000. Margin of safety in dollars is the actual sales minus the break-even point in sales. It's $37,500. Learning objective number 2. Sales mix is the relative percentage in which a company sells its product. So what we're talking about now is a company that sells multiple products. So they have product A, product B, product C. Sales mix is the relative percentage in which a company sells its product. What percentage of product A do they sell in comparison to the total? If a company's unit sales are 80% printers and 20% computers, its sales mix is 80-20. Sales mix is important because different products often have different contribution margins. For example, companies compute break-even sales for a mix of 2 or more products by determining the weighted average unit contribution margin of all the products. Vargo Electronics sells not only cell phones, but high-definition TVs. Vargo sells its products in the following amounts: 1,500 cell phones and 500 TVs. What's the sales mix? The cell phones, 75% of total sales, 1,500 divided by 2,000, and the TVs represent 25%, 500 units divided by 2,000 units. Some additional information. We now have the selling price per unit and the variable cost per unit for the cell phones and the TVs. And we know the sales mix, and we know the total fixed costs. First, determine the weighted average contribution margin. So on the bottom here, you can see that we have the contribution margin for the cell phones at $200 per unit. And we know that cell phones represent 75% of sales in units. And we have the TVs, where the contribution margin per unit is $500, and that represents 25% of sales. So we have a weighted average contribution margin per unit of $275. So determine the weighted average contribution margin. We just did that. What is the break-even point in units? The total fixed cost of $275 divided by the contribution margin, weighted average contribution margin of $275. They need to sell 1,000 units in total between the two products, cell phones and TVs. Well, how many TVs and how many cell phones? Well, go back to the sales mix. Remember, it was 75-25. So they're going to sell 750 cell phones, 75%, and they're going to sell 25% TVs for the 1,000 units. Multiply it times the contribution margin for each one of these things. There's the contribution margin to be achieved. Remember, fixed costs were $275. Your break even. Contribution margin minus fixed cost equals net income. Break-even sales in dollars works well if a company has many products. It calculates break-even point in terms of sale dollars for divisions, product lines, not individual products. So we have a company here, Kale Garden Supply Company, has two divisions, an indoor division and an outdoor division. And you can see that on their indoor division, they have $200,000 of sales, and they have a contribution margin in dollars of $80,000. Their contribution margin percentage would be 80 divided by 200, but their sales mix is 200,000 of the $1 million. So the sales mix, indoor has 20% of the sales and outdoor has 80%. Well, what's the contribution margin? You can clearly see that even though the indoor division has a lower sales mix, they have a higher contribution margin ratio of 40%. The outdoor division has 80% of the sales, but their contribution margin ratio is lower. It's at 30%. So when we calculate the weighted average contribution margin ratio, we take the total contribution margin, that is the combined contribution margin, and divide it by the total sales. So in this case, 32%. So we want to calculate the break-even point in dollars. That formula, very similar, fixed cost divided by the weighted average contribution margin ratio. The fixed cost with $300,000. The weighted average contribution margin ratio, 32%. Break-even point in sales dollars, $937,500. With break-even point in sales dollars of $937,500 and a sales mix of 20/80, you can clearly see, you take the 937 times 20%, indoor has $187,500 in sales, outdoor, which gets 80%, $750,000 in sales. If the sales mix becomes 50-50, the weighted average contribution margin changes to 35%, resulting in a lower break-even point of $857. So here's a question for you. Net income will be greater if more higher contribution margin units are sold than lower contribution margin units. Absolutely true. A. So we have another example. Bicycles International produces and sells 3 different types of mountain bikes: the Pro, the Intermediate, and the Standard. They sell a total of 40,000 bikes, but you can see it's widely varied. They sell the most of the Standard at 25,000 units. The selling price for each one of those bikes, you can see the variable cost for each one of them listed there as well. Company's total fixed cost is $7,500,000. A, determine the sales mix as a function of units sold for the 3 products. So you can clearly see it's the number of units for each product divided by the total units, and you've got the sales mix there. Determine the weighted average unit contribution margin. So we're using these percentages. You start with the relative sales percentage, for this case the Pro at 12.5%, multiplied times their contribution margin, which is $300. Do the same thing for Intermediate, the same thing for the Standard. Their weighted average contribution margin per unit is $150. Determine the number of units that the company must sell to break even. Right? It's the fixed cost divided by the weighted average contribution margin per unit. It's 50,000. So they need to sell a total of 50,000 units to break even. Obviously, when they sell only 40,000, they're going to lose money. So here's the number of units they need to sell for each one of these, right? It's the break even in units multiplied times the sales mix percentage. And those are the number of units of each they need to sell. Learning objective 3, determine the sales mix when a company has limited resources. All companies have limited resources, whether it be floor space, raw materials, direct labor hours, etc. Management must decide which products to sell to maximize net income. Vargo manufactures cell phones and TVs. Machine capacity is limited to 3,600 hours per month. So we've now provided you with the contribution margin per unit for cell phones and TVs. And we're also telling you the number of machine hours required per unit. Approach used to identify and manage constraints so as to achieve the company's goals, which are what? Maximum profitability. Company must continually identify its restraints and find ways to reduce or eliminate them where appropriate. So let's calculate the contribution margin per unit of limited resource. So you can see you're going to take the cell phone contribution margin of $200 per unit divided by the machine hours per unit. The contribution margin per unit of limited resource is $1,000 for the cell phones, $800 for TVs. Management should produce more cell phones if demand exists or increase machine capacity. It's essentially the goal. If the contribution margin per unit is $15 and it takes 3 machine hours to produce the unit, the contribution margin per unit of limited resource is 15 divided by 3, right? $5. Carolina Corporation manufactures and sells 3 different types of high quality sealed ball bearings for mountain bike wheels. The bearings vary in terms of their quality specifications, primarily with respect to their smoothness and roundness. They're referred to as fine, extra fine, and super fine. Machine time is limited. More machine time is required to manufacture the extra fine and super fine. So they're providing you the sales price per unit. You can see the super fine is the most expensive. Variable costs and expenses, and contribution margin. Machine hours required for each one of these. What is the contribution margin per unit of limited resource for each type of the bearing? So it's going to be what? It's going to be the contribution margin divided by the machine hours. indicate how operating leverage affects profitability. Cost structure is the relative proportion of fixed versus variable costs that a company incurs. May have a significant effect on profitability. Company must carefully choose its cost structure. Vargo Electronics and one of its competitors, New Wave Company, both make cell phones. Vargo uses traditional labor-intensive manufacturing process. New Wave has invested in a completely automated system. The company employees are involved only in setting up and adjusting, maintaining the machinery. So you see here, you see two companies, Vargo and New Wave. They both have exactly the same sales dollars at $800,000, and they both have exactly the same net income of $120,000. But what's different? The mix between variable and fixed cost. Vargo has substantially more variable costs than they do fixed costs, and New Wave has significantly more fixed cost than variable costs. So you can clearly see here the contribution margin. So the contribution margin ratio is the contribution margin divided by sales. We know that. For Vargo, it's 40%. For New Wave, it's 80%. What does this mean? New Wave contributes 80 cents to net income for each dollar of increased sales, while Vargo only contributes 40%. Therefore, New Wave's cost structure relies on fixed cost, is more sensitive to changes in sales, right? New Wave has substantially more fixed cost. They rely on fixed cost. They're more sensitive to changes in sales. Effect on break-even point. You can clearly see here, it's the fixed cost divided by a contribution margin ratio. New Wave has a much higher break-even point in sales dollars, $150,000 more. Effect on margin of safety. Remember, it's actual sales minus break-even sales. You can see that Vargo has a much higher margin of safety than New Wave. Vargo can sustain a 38% decline in sales before operating at a loss versus only 19% in New Wave. So Vargo is essentially in better shape. So that's all I really want to cover from this chapter. Appreciate it. We'll talk to you soon, and we can end this session now.